I'm Chimbozrim, and this is Equity Merchants. Africa's startup funding landscape is rebounding after some turbulent years. This year, debt financing has crossed the $1 billion mark, narrowing the gap with equity. But is this a sign of debt becoming a sustainable path for startups, or simply a reflection of tough times in venture capital? Meanwhile, Cleantech is closing in on fintech as one of the most funded sectors on the continent. Yet, despite the growth, one thing hasn't changed. Male-led teams continue to capture nearly 90% of funding, leaving female founders to compete for just a fraction of capital. Faith Omoniyi, content editor at business intelligence platform Brighter Bridges, joins us to unpack these trends. So let's just start with the conversation on debt funding. It's just crossed the $1 billion mark this year, and it's very close to what founders are raising or what startups are raising from equity. In your opinion, what do you think is driving this move or this shift towards more debt funding?
All right. Thank you so much for having me. I think primarily most debt funding are going to climate tech startups, right? And solar powered startups, and mostly startups that need debt to run. So previously, you would find out that startups raised equity to then do debt work. Of course, now they collect debt for maybe operational expense or to give out the debt back. For example, climate startups that give out loans, like that do buy now, pay later solutions and all of that. So it's better to use debt to fund that than to use the equity you've raised. And you see African startups raising debt to reduce the kind of so that they can increase ownership, right? When you raise too much equity, you get diluted and all of that. So I think that's part of the shift we're seeing. And even VC funds themselves, they're raising specialized funding just for debt, right? Instead of just raising all of this for equity, they're raising debt fund as well. So yeah.
Okay. So do you think that this is like a more suitable financing option for African startups, or is this just a result of where we are as an ecosystem?
I wouldn't say it is suitable. It's not like a one size fit all. Like I said earlier, it is ideally for businesses that need it. So if your business is a credit company and you give some form of credit, buy now, pay later solution, some loan, it just makes sense to use debt funding for that kind of business model. Not all business model are suited or are suitable to receive debt funding, right? Of course, founders collective for maybe one or two reasons or many reasons. One, they don't want to dilute themselves. They still want ownership of the business. And number two, debt is just suitable for that line of work. So it does not make sense to raise an equity round and then use it for debt, right? In practice. So yeah, it's not suitable for every business. And again, businesses that necessarily do not need debt should not take it, because sometimes it might stifle innovation in a way, because people are just focused on paying back the debts and they're not like exploring other verticals that could lead to innovation and all of that. So yeah.
Okay. So just looking at the sectors that have gotten most of the debt funding, Cleantech and in particular solar products have gotten most of the debt funding so far. What do you think this says about the sector, or what does it say about the industry?
Oh yeah, like I said at the beginning, most of the debt funding has gone to climate tech startups, right? Those startups, they require it because most of them give credits in some form, and most of them are very, very capital intensive, right? So it just makes sense that they get debt to offload that, and then they keep on the process instead of just diluting whatever it is that they have. And it's interesting to note that most of the I know climate fund was like maybe the second or third in funding volume, and about two startups raised half of that amount. That's Solar King, Delight, right? So because they are very, very capital intensive in nature and they require a lot of credits to run their business model. So it just makes sense to get debt funding instead of equity for that line of work.
Okay. Mhm. And moving on to just the gender spread for funding,
Mhm.
startups are either male-led or male-founded, continue to raise nearly 90% of the funding.
Mhm.
We've seen a lot of talk about why and how quickly we need to move, like just move quickly and get more women funded. Why do you think there's very slow progress on this front?
Okay, so I think the major reason is because there are just very few women in the arena as compared to men, right? When you look at it, only 20% of tech startups have at least one woman or one woman co-founder, right? And only 10% of startups on the continent are led by women. So the disparity is just there to begin with. So ideally, more funding will go to men startups, right? Male-led startups, I beg your pardon. So I think that's just like the primary reason. But it does not mean that it does not mean that funding is not also going to women. There are VC firms like Django Capital, like Arua Capital, Alitia, IDF, First Check Africa, who like constantly promotes funding to women, right? There's that VC backing. It's just that um, in the arena there are just very few women who are building stuff. So there'll always be that disproportionate what's the word now? There'll always be that
A
disparity
gap.
in funding. Yeah.
Oh, okay. So you've pointed out that there are few women building startups, which just makes it a bit harder to get to just balance
Mhm,
out things.
mhm.
But what do you think investors on their part can do to ensure that we have more women receiving funding?
Okay. So yeah, there are women-led VC startups, which, of course, would want to promote gender balance, right, within their portfolio companies, right? Django Capital, for example, they have 56% of their portfolio is of their portfolio company is women-led, right? And we have Arua Capital as well. We have First Check, which is led by Odun Irini of PiggyVest, and those women-led VCs will advocate for more women ventures. Of course, they will still look at the fundamentals, your business model and your unit economics and every other thing that you're building. But then you see that they will advocate for more women company in their portfolio. And yeah, so I think there's work being done towards that. And yeah, mostly.
Okay. So Nigeria has lost its, I guess, position as the major funding source on the continent. I think this is probably the third year in a row where we are seeing less funding go to Nigerian startups compared to startups in Egypt, in South Africa, and Kenya.
Mhm.
What are some factors that are responsible for this?
Okay, so this year, according to data from Brighter Intelligence, African startups have raised 2.8 billion, and 2.4 billion of that, $2.8 billion and 2.4 billion dollars have been raised by the big four. That's Nigeria, South Africa, Kenya, and Egypt, right? In terms of why Nigeria has lagged behind, Nigeria has raised about 182 million, right? Lagging behind Kenya, South Africa, and Egypt. Kenya has raised the most money. I think it just boils down to the size of the deals we've seen in Nigeria, for example, right? We've not seen a lot of mega deals in the country. So, for instance, in Kenya, Sun King raised about 236 million this year. Another Kenyan startup raised about Delight raised about 300 million this year. While in South Africa, YearX raised about 100 million through its merger with the US-based firm. In Kenya as well, Bond raised 90 million. While in Egypt, Nawi, the property listing company, raised about 75 million. I could go on and on about those mega deals. But here in Nigeria, so let me put it into perspective. The big four, there's been 330 deals, right? And Nigeria leads with 95 deals. while other regions have 80, 81, and 74. But most of our deals are very low ticket sizes, right? The highest has been Lemfi's 56 million raise. So when you compare that with South Africa, which has raised a startup in South Africa, which raised 100 million, another startup in Kenya, which has raised about 300 million, Sun King has raised about 236 million, Norway in Egypt has raised about 75 million, and Zips from South Africa has raised 165 million. When you compare all of that, so it appears as if Nigeria's raised less funding, but then those funding in other big four region are propelled by mega deals. So if you take away all of this, it might still boil down to the same thing. So I don't think I think that is like the primary reason because Nigeria still leads in deal size. That's 95 deals have been done here in Nigeria, while South Africa has 80, Kenya has 81, Egypt has 74. It's just that um, the deals in other regions are very, very heavy.
Yeah, so just going by that, do you think there's a chance that Nigeria bounces back either this year or say sometime next year?
Well, there's every possibility for that to happen. Then again, when you look at the business that have been funded in all those regions, they're mostly climate tech startups, right? So you see Delight, for example, a climate tech startup raised 300 million. Sun King, for another example, raised 236 million. Most of our heavy hitters here in Nigeria have been fintech and they've not raised such large amount of deals. So maybe in the future, of course, we might have a new dynamic where Nigeria is back at the top and back at the top of the big four.